So we look at market rent. We have a couple of different data providers on the back end, and then we also look at comps in the market.
Listen, I would imagine depending on how long you've lived in the house, that number might shock you.
It would probably shock a lot of people, yeah.
Yeah.
If you've had that mortgage for 20 years.
Yeah, we were just talking about I've had my mortgage 17 years and, I have an $1,800 mortgage payment that for a similar house today is probably $2,500 rent.
Yeah.
So some people might be saying that might catch people off guard. I mean, it is what it is, but they're going to be shocked
As
by
a
it.
landlord, I can appreciate the other side, though.
So welcome to another episode of the Context to Contracts podcast. I am Bryan Lovell, always here with the amazing co-host, Mr. John Jones. And we have a super special guest with us today, Miss Julie. I'm going to butcher your last name. Is it Raisch?
Raisch is great. Yeah, that's it.
Is that it?
Nice work.
Boom.
Sure.
Nailed it.
Did it. Yeah.
From
you didn't cut out the part where you said you're going to butcher it. There you go.
So thanks for joining us from EasyKnock. And, we John and I have been having a lot of conversations on the podcast lately about this is a
smoking hot market we're in. It's very unique.
Very, very unique. Can something be very unique, by the way?
I don't think this has ever happened, right? I mean, 2004, 5, and 6, it was smoking hot, but it wasn't. There was plenty of inventory.
Yeah.
So you're off. You if you were looking to purchase at that time, plenty of loan options and plenty of properties to make offers on, and it was never. In most cases, not a lot of multiple bid, like what we're seeing now.
Yeah. So I think in market-wise, we're definitely in uncharted territory. And we brought Julie on today to share with us a little bit about a product that they have at EasyKnock that's kind of helping buyers bridge the gap for where they need to go in the market that we're in. But hey, I just figured you have a pretty interesting background in various stages of real estate, both residential and commercial. Can you share with us a little bit about some of your experience, what you've done?
Sure, absolutely. And thanks for having me. So I'm Julie Raisch, VP of Business Development at EasyKnock. I guess really 20 seconds of my career. I started off at Goldman Sachs, and then I've been in commercial real estate, kind of prop tech ever since. So joined a company called CompStack. We were basically crowdsourcing lease comps for commercial office assets all across the U.S. So launched 90 markets for them in the U.S., then was over doing that in London, got into the London property scene. Then I joined a little company called WeWork, and there we were basically I ran business development for them. I was over in Asia, in China for a little bit over a year, and then I was in India for a year. So a lot of that was really around how do we partner with big, for us, it was big brokerage partners, right? And so then when I came to EasyKnock, I was looking at this really interesting market that we have and an opportunity to help homeowners with unprecedented levels of home equity. Can we creatively help homeowners to access that equity? So that's what I do here. I look over all of our partnerships. And so slight difference from previous companies I've been at, but the people we're partnering with are large real estate brokerages and then obviously lenders and brokers themselves.
Yeah, cool. So, hey, one question we have before we get into the products real quick. You guys do all states?
Yep. We're in all 50 states. Our only kind of delimiter there, we don't do super rural properties, but everything other than that, just because a lot of our business model as we go into it is based upon the homeowner being able to resell.
Sure. So, John, let's set up real quick kind of like the type of borrower, consumer, whatever we want to call it, that might benefit from EasyKnock. So one of the things that we're seeing in the market right now is, let's just take a move-up buyer as an example. You or I could classify into this like, hey, we have a home, we've lived in it for a number of years. Maybe we want to get something bigger. We face a couple challenges in the market. One,
Sure.
Can we make an offer that's contingent on the sale of another? And two, we need the equity from this sale to help us to compete in an environment where we're going to have to bid over ask.
Yeah, I mean, I think it's a challenge right now. If you wanted to just go from one to another, it might be easier for you to find a new home and then list the current home because the current home is going to go quick. I mean, if it's priced right, it's probably going to be under contract within days.
Yeah.
Of listing. And then the challenge is with limited inventory is the buyer trying to find that ideal property for the move up.
Yeah, absolutely. So Julie, could you talk to us a little bit about a solution that you have at EasyKnock that could benefit the scenario John and I just kind of talked about?
Bridge the gap for us.
Of course. Yeah. And bridge is a good word to use, right? So, John focused on this a little bit before, which is there's a real inventory crisis out there, right? And we feel at EasyKnock, and what we're seeing in the market is that this disproportionately affects folks who need to sell that home before they buy the next one, right? So anyone that's going in with a home sale contingency, I also think when you think about it at a macro level, right? Think about the amount of work from the LO to the realtor to the potential home buyer that goes into 20 offers on one home. Well, 19 of those is kind of a waste of time, of everyone's time, right?
Yeah.
And so this is something that, it's a solution that we partner with our lender broker and then agent realtor partners. We partner with them to help that homeowner to access the equity in their current home. So they sell the home to EasyKnock, clears the existing mortgage on the existing home, can clear kind of any, whatever other liens are against that home. And then they've got cash in hand. They're renting back from EasyKnock. So they've got a totally flexible lease on the back end. And then that lease terminates whenever they sell the home on the open market. So if you think about it, here we are, what is it, April right now, you're looking at a move, you want to get through the school year, but you need that cash in hand. And so this would be a great solution for a homeowner that's maybe a move up buyer. They need to get that cash out. They don't want to uproot, especially you don't want to move a family into the Embassy Suites for 3 months, right? and kind of hang out, or as my CEO likes to say, his worst nightmare is the in-laws, right? Like he's like, I started this whole company to avoid moving in with them when I needed to. But you get that cash out, and then they're a more powerful buyer in the market. They're non-contingent, and it makes them more competitive. And as we're talking about kind of like economies of work in this offer process.
Yeah.
Cool. So I'm curious, is there a time frame from when you lease the house back to the homeowner? What's your target time frame? Do you allow that to go on month to month, or is it 6 months or a year?
It's even more flexible than month to month. We basically buy the house from them and we become their landlord, right? They get cash in hand. They get up to 85% of that home's appraised value in their hand, right? We're going to clear that mortgage value. We're going to clear that mortgage balance, and the rest gets wired to them. And then they rent back. And so whenever that home sells on the open market, not only does that end their lease, right? So this could be 4.5 months or 3.7 months, whatever it is. Not only does that end the lease, they get any home price appreciation. So to keep it fair, we buy the home at the appraised value. But as you guys, I'm sure, are seeing, right? Everything's selling over appraised value. So all of that incremental goes to the homeowner.
Wow. So
nice.
So a couple of things I really like about this real quick. So one, that was one. So EasyKnock buys a home for you right now in April. You go to sell it in August. If there's any additional equity or appreciation, that goes to the buyer, right? Well, in this case,
the seller.
The seller, right? But two, so Julie, you said you guys will do up to 85% LTV. So one of the things I think is a tool that loan officers should be using is that they're gonna set up their new mortgage for their new house, right? Then they're gonna list the home for sale that currently EasyKnock owns. When they get the rest of the additional appreciation and the other 15% equity out of the home, they could do a one-time payment recast on the mortgage that they just took out. So what that is one-time principal reduction, and we recast the mortgage based on the new principal balance.
Yeah, I like it.
Yeah.
Any other, so in that case is there any benefit for the buyer going forward in the new home to have, a cash backup contingency plan with you guys? You guys offer that?
They've got what do you mean in terms of a cash backup?
So similar that if the lender fell through on the purchase and wasn't able to close on the 30th of April, let's say that you guys would do a lease back on the new property they're trying to get into.
Got it. So a cash buyer program or power buyer program on the forward purchase.
Yes.
It's something that we've looked into. I can't talk too much about it, but our current product, what it does is it gives the customer cash in hand, right? So when they need to bid over appraised value, right, and they're getting their mortgage from Van Dyke, but they're only getting finance up to that appraised value, having more cash just makes them more powerful in the market as well.
So on this product that you just shared with us, two additional questions. One is, what does it cost?
Yep. So we're going to buy that home at the appraised value. And so something really interesting is that, we'll charge depending on the closing cost environment in the state, between 3.49% and 3.99% of that purchase price of the home. Now, where that gets really interesting is we're seeing month over month appreciation in a lot of markets. So if you have someone that's renting this home back for 4 months, it's paying for itself in a lot of different markets, right?
Yep.
And so then as they're renting back, they're getting, like I said, that appreciation. So if we had that home appraised at 200 or right when we took title and we bought that house from them, it could very well sell for 240, 230, right? We're seeing that in a ton of different markets. All that incremental goes into the customer's pocket.
Now, can they use any real estate agent that they want to facilitate the sale of the property?
Absolutely. Yes. And so I'd say the only kind of caveat to that is that we do partner with realtors, right? And so if a realtor is bringing us a customer, they're part of that. It looks like a sleeve transaction for them, right? So they'll come in, do the deal with EasyKnock. The customer becomes a renter, and that agent will work with that seller then to sell that home on the open market and get the best sale price there, so they get as much appreciation as possible. It can be really interesting too when you think about just, where a little investment of $5,000-$10,000 means that you can see outsized returns on the sale in the open market. All those kind of staging costs that people have been putting off, stuff like that.
Yep.
Yeah.
And what's the rent back cost? Do you guys have a multiplier that you use to calculate
market rent?
Okay.
Yeah. So we look at market rent. We have a couple of different data providers on the back end, and then we also look at comps in the market.
Listen, I would imagine depending on how long you've lived in the house, that number might shock you.
It would probably shock a lot of people, yeah.
Yeah.
If you've had that mortgage for 20 years.
Yeah, we were
like
just
in our
talking about
case.
I've had my mortgage 17 years and, I have an $1,800 mortgage payment that for a similar house today is probably $2,500 rent.
Yeah.
So some people might be saying that might catch people off guard. I mean, it is what it is, but they're going to be shocked
As
by
a
it.
landlord, I can appreciate the other side though.
Yeah, I get it.
In a bake-off between your mortgage payment and the rent, obviously the rent's going to be more expensive. We are covering property taxes. They're getting the flexibility of not having to move twice. They're also just getting that just general flexibility and access to cash. So really kind of apples to apples there. Also with a customer that maybe has a high DTI or has some high interest debt to clear off, right? That can definitely drastically make a swing in the monthly payments.
When you think about this, right, as a strategy, you've got some naysayers out there, and while you and I might understand the market's probably not going the other way. Right?
You're meaning appreciation going backwards.
Right.
Okay.
Right. I don't even want to say that word. It's like shank and golf, but
We're saying the R word.
Right. For a strategy as a home seller, you could sell the home to EasyKnock, lease it back. Let's say you did think that way, right? You did believe the naysayers and there's a bubble. I mean, is there any benefit to, I guess?
Are you asking if there's any benefit to being a long time?
What would happen
leaseor?
if you gave, if you bought it at for example, if somebody believed that the market was going down and you sold it to EasyKnock at 85% of appraised value?
Sure. So if there's a big swing, right, and say that home goes from 200 all the way down to 150, when we say we fund up to 85%, the remaining 15% sits in what we call an option value, right? And so that means if it sells flat on the open market, they're getting that remainder straight. But it's usually selling at a premium to that, right? We've been seeing a drastic premium to that. If it were to dip, that's their exposure there, right? Yeah. If it dips below that, we eat that, right? So there's going to be there's no scenario. So they're getting the upside and the downside, but there's no scenario where we're saying, hey, the home value dipped, you owe us $20,000 PX.
They're banking on there being appreciation. In the home.
And like I said, I don't. If we had a dip, it's not going to be what it was in 2007.
Yeah. So, Julie, I don't know if you have this data or if you can even share it with us, but I'm just curious, how many transactions are you seeing that are done like this?
Sure. So we've been in business since 2016. We've really basically been doing this product for about 3 to 4 years. Took us about 2 years to kind of figure out the legality of what we're doing and make sure we paper all these transactions, interestingly. So been doing this for a few years. I've seen the majority of our growth. We tripled the business last year. So we've done thousands of transactions nationally. In terms of our movability product, which is that bridge product, is a little newer. It really came about because we had some very entrepreneurial realtors that were saying, love what you guys are doing. Instead of doing it on that longer term lease back, can I just do this in a bridge scenario? Right. And so we really then built a program around that.
Yeah. Okay.
Nice.
So just curious, what are some of the states that you see the highest traffic or transactions in?
So we see, and a lot of it has to do with our partners and where they are, right?
Sure.
Our biggest states are Florida, Georgia, and Texas. Texas is a large chunk of our portfolio. And then, we've got North and South Carolina. Doing a lot and we've transacted in I would say most states. I don't think we've done anything in Alaska or North Dakota yet or anything like that.
Okay,
yeah, I'll say yet on that one.
Yeah.
But for us, it was really important to kind of serve the partnerships that we were interested in, that we go pretty much national as opposed to market by market.
So you had mentioned the bridge product is really only one of your products. What are some of the other products that you guys are doing?
So our core product is really focused around, and it's the same thing, right? It's just a longer version of the sale leaseback. So it's an experience where we're going to buy that home from the customer. They are going to get that cash and they're going to be able to remain in their neighborhood, their school district, in that home without uprooting the family. This could be somebody who maybe was looking for a cash out refi or a HELOC, and because of either their credit, their DTI, their income type, a lot of non-W-2 employees, they're not going to qualify for those products, right? And so this could be a really great alternative that will allow that family to stay in their home, like I was saying, and it's a private sale. They're going to stay there without kind of putting that for sale sign out on the front yard, and then get access to that cash. And then in our longer term product, they preserve that option to repurchase the home. So that's something that, customer control in all of our products is something that is really core to what we're delivering. So at any point, that customer can repurchase their home the same way that in our bridge product, they can choose to move in or not move in, they're already there, but they can choose to enter the program and then they can list that home the next day, right? And so for us as a rental landlord, obviously, we could be looking at maybe just 3 weeks of rental income on that, right? But it'd be worth it for the customer.
Sure.
So if they decide to purchase the home 6 months later, what's the strike value there? Or is it what you entered into at the beginning, or is there appreciation factored into that?
So this is our sell and stay product, right? And so this is a longer term sale leaseback. How it works is that we're a little more conservative on that one. So we're going to give them up to 75% of that appraised value.
Okay.
So I'm going to pick some very easy numbers here. Let's say that home is $400,000 appraised right on the dot. And so we would give them $300 up front. That repurchase price is locked in at that $300. So if they want to repurchase it down 3 years down the road, or they want to purchase it 18 months down the road, whatever it is.
So basically, they need to pay off the lien. That's the long and short of it, right?
We're taking title, right? There's no lien on the property. So when we fund that $300, we're paying their initial mortgage, right? That primary lien on the home. Then we take title where the homeowner, there's no loan, but they would likely, unless they're repurchasing
they
it
can
in
buy
cash,
it back for $300.
Yeah.
That's what I'm saying.
Yeah.
They're going to buy it back for the amount of money that they got from EasyKnock, right?
Yeah.
So this is interesting. So if the ideal consumer who would take advantage of something like this is somebody who doesn't necessarily credit qualify to do a cash out refinance on their home.
Maybe change jobs, right? The situation, they're newly self-employed. They need to access money to start up a business, right? And they jumped into it, and they're not going to qualify right now.
Okay.
We tell them it's going to be a year or two. So they would go this route and know that they basically are just hedging. They've got the house, and once they're ready, they come back and buy it back.
Yeah. Okay. That made me think, though, on the original bridge product that we were talking about, do you credit qualify the buyer? So meaning, like, you want to make sure they're going to be able to buy the new property.
Mm-hmm. So we'll work with homeowners across the credit spectrum. We don't look at credit score, because what we're doing is we're not alone, right? We're taking principal on the home. We're taking title. We're principal on the transaction. And we're going to be their landlord. And so we can work with them because we have that option value and we're doing this transaction. Somebody that maybe, we need to do a holdback of rent, prepayment, kind of like more of a security deposit type experience. Yeah.
Okay. So what questions haven't we asked that we should have?
You can almost use this product like a reverse mortgage. If you didn't have a mortgage and they gave you'd appraise that same property at $400, you could get your hands on $300.
Yes.
And then, lease it back for as long as, as you need it, or you had access to all that cash.
Yeah.
I'm assuming that's correct, right? You'd have $300 to go and play with.
Yep.
You'd have $300 to go play with, but you're still making a rent payment to them.
Yeah, right.
You're just not paying back the $300 until you want to take title of the property back. Is that?
Exactly.
Yeah.
Exactly. Mm-hmm. Yeah. Couple of different interesting use cases too, just to the extent that you come across, potential borrowers that look like this. It's Also, we work a lot with divorce, kind of inheritance. There's a couple of different ways to do that, but just anywhere where there's a situation where someone wants to liquidate at least part of that asset, right? And then either retain that repurchase right, or they're not looking for that repurchase right. They just want time and flexibility.
Yeah, good.
So she brought that up. I mean, a divorce would be a good case for this, right?
Yes.
The spouse might not qualify currently to do an actual mortgage.
Yep.
And this gets them, separate on title. Okay, I like that. Any specific other scenarios that work well with these programs that you do a lot
I would
of?
say as a subset to our just kind of broadly bridge and killing contingencies, anyone that's moving into new construction. So whether you are renovating a future home, maybe you've purchased a fixer upper. I know we're seeing that in a lot of markets, right? People, as much as you love a turnkey property, when there's only X, available in that market, and you really want to be in that school district, you want to be in that neighborhood, people are changing then and saying, okay, maybe I do want to, I didn't want the whole project of fixing up this house, but looks like I'm going to. And then if you think about the supply chain constraints that we have in the market today, those are folks that, maybe they're saying delivery is going to be September, might be a little bit more like November, it's just
good luck getting a refrigerator.
Yeah.
Yeah, exactly. The igloo cooler is going to have to work.
Yeah.
So, we work with a lot of folks that are kind of in those types of moving situations as well.
Cool.
So I started to ask, is there anything like we should be asking? Is there something that we've missed? Think of it in terms of like, hey, if loan officers and real estate agents are going to watch this, what does their ideal client look like? Do you want to spell that out a little bit more, or did we cover that?
I could definitely do that. So I would say there's two subsets, right? There's the client that just really simply needs to sell before they buy, right? We can be a solution. We're available in a lot of geographies. That person just needs to have obviously an equity position in the home that's significant. So we're usually looking at like less than a 65% LTV just to make the transaction meaty enough and worth it, right? That's probably the ideal customer subset, right? Somebody that bought 3 years ago on an FHA mortgage, once they go through this transaction, it's not really going to be enough.
Yeah.
So I would just say that wouldn't be the best use of everybody's time. So that customer that needs to sell before they buy, and then also anybody broadly that's looking to get access to that home equity while they stay in the home. So we were talking about those different scenarios there: divorce, starting a new business. We were talking about kind of just somebody that maybe doesn't qualify right now for a HELOC or a cash out refi, keeping them in that home in that neighborhood. These are all consumers, that we could definitely help. Okay. And it's additional, to the extent that you're thinking about leadership as well. It's another revenue opportunity. I would say for the broker, right, and for the lender. So we could talk a little bit about that. I mean, I'd love to hear how you guys are thinking about product diversification.
Yeah, I mean, I think for us, the way we would be presenting this is to our loan originators to help them find ways to do more transactions, right? And obviously, the win for them is they ultimately get to do the loan for the home that they're going to buy, and the agent that referred them, that person in the first place, is going to be able to get the listing still, when they go back to sell that home. I think that's probably the way that we're.
Yeah, I mean, the hardest thing is most homeowners now, that's the fear. If they don't know about a program like this, the fear is, I'm looking at what's available right now, and we have been and I have several friends, for example, that are doing this. I don't like anything. Yeah. And I don't want to settle. So you know what? Until this bubble slows down a bit, I'm going to just stay put. Yeah. Where this gives them an opportunity to just go forward and and be patient. If they really do want to sell, find that home. Yeah. And have the cash ready when they do find that home, or go back and just stay where they're at and pay back that loan. Yeah. So, I mean, I love having, it's more like the last few years getting very creative on how to help homeowners with what we're all going through.
Yeah. I mean, and that's really, when you think about probably in the last 6 weeks of us doing some podcasts, I think we've done 4 on this subject.
More focused to the power buyer, right? I mean, and you're going to get that product out to us, I'm sure, in the near future. But you've got to be creative and help all those sticky situations. Yeah. Especially the bridge part.
Yeah. 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 People ask us about bridge loans all the time. I mean, in essence, this is a bridge loan.
Non-lending bridge tool, but yeah. Okay. It's a bridge.
Right.
It's helping in a bridge scenario.
You're right. Yeah. It's technically not a loan. So yeah.
The fear of some is, I'd rather still own my house, right? And have control of it, where that would be the bridge scenario. In this case, it's trusting and, agreeing to lease back your own property.
Sure.
Some people will have that hurdle, I'm guessing, to overcome how that all works.
Yeah.
In that scenario.
For someone that's planning to move, especially, right? If you're planning to move, then keeping title on it for that remaining 3 months is, that's the trade-off, right? For you being
Right.
non-contingent.
Yeah.
And so they'd rather resolve that home sale contingency. And then for someone who's looking to stay in longer term, it's, we're keeping them in control, right? They've got that repurchase option, but it's giving them that access to that cash up front to fix whatever scenario they're in.
Well, I think the one thing does is it buys you a little bit of time. Okay. And let me explain what I'm talking about is we're in a market today too, where we've got to get creative with the offers that we're making. And we're seeing, I think I saw a stat just today that 70% of purchase agreements right now are over ask. Okay.
Correct.
So if I already have the assets from the sale of my home, I can get creative with how I want to make an offer to somebody, right? Meaning, obviously I'm not going to be able to make an all cash offer to somebody if I'm moving up, but I'm going to be able to use those assets how I want to frame the offer that I'm going to want to make, and working with a loan originator on what financing options do I really want to do. So like what you and I have talked about on the show,
Instead of putting 25% down, you go in with 5 or 10% and you use the extra money for that over ask.
Boom. And then once you settle on the purchase of this house and you go back and you list the old one, you're going to get some additional equity from the sale of your home, maybe some additional appreciation, and you take that combined with the assets that you had left and you make that principal buy down and you eliminate the mortgage insurance. From the mortgage that you got. So there's just, I think it buys you a little bit of time and to give you flexibility of options for offers. Right.
Yeah. Yep. And by all means, if you're selling real estate, you've got to know about all these products.
You do.
Yeah,
you do.
You do. That's definitely a challenge we're in right now.
We're in right now. Yeah. Cool.
All right.
We got anything else? Julie, sorry.
No, you're good. No, I think we covered a lot there.
Cool. So, hey, thanks for joining us. We'll make sure in the description we let people know a way to get in contact with your company. If you've got any questions about EasyKnock, either as an agent or as a loan originator, we'll make sure that you get in contact with the right people. But Julie, we want to thank you for jumping on the show. I know you've got a busy week coming up with a conference. Yeah. So you fit us in the little bit of time that you had. We appreciate that. On behalf of John and Julie, I'm Bryan. We want you to know if there's anything that you need, we're always here to serve.
Thanks, Julie.
All right. Thank you.
See you.